Economic indicators serve as vital signposts, offering clues about the health and direction of an economy. These measurable statistics, such as unemployment rates, consumer spending, and manufacturing output, are closely watched by experts for early warnings of downturns. When certain indicators begin to shift, they can signal the possibility of an approaching recession, often before its effects are felt by the public. The ability to interpret these signals is crucial, as it allows governments, businesses, and individuals to prepare for turbulent times. Ignoring these early warnings can lead to missed opportunities and unexpected challenges. In the intricate world of economics, listening carefully to these signals can make all the difference between resilience and vulnerability. An inverted yield curve occurs when short-term interest rates rise above long-term rates, a phenomenon that is often viewed as a warning sign for the economy. Typically, investors expect higher returns for lending money over longer periods, so long-term rates are usually higher. However, when short-term rates surpass long-term rates, it suggests that investors are concerned about the future and expect economic growth to slow down. Historically, this pattern has preceded many recessions, as it reflects a lack of confidence in the economy's prospects. The inversion signals that market participants believe central banks may need to lower rates in the future to stimulate growth. As a result, the inverted yield curve is closely watched by economists and policymakers as a potential indicator of upcoming economic downturns. Rising unemployment claims often serve as an early warning sign for the broader economy. When more people begin filing for unemployment benefits, it suggests that businesses are reducing their workforce, possibly in response to declining demand or financial pressures. A steady increase in these claims can indicate that economic trouble is developing, even before other indicators reflect a downturn. This trend may point to growing uncertainty among employers and a potential slowdown in economic activity. Monitoring unemployment claims helps analysts and policymakers anticipate challenges and respond proactively to shifting conditions. Falling consumer confidence is a critical indicator of economic health. When individuals feel uncertain about the future, they often choose to cut back on spending, postponing major purchases, and limiting discretionary expenses. This cautious behavior can have a ripple effect throughout the economy, as consumer activity accounts for a significant portion of overall economic output. Reduced spending slows business revenues, which may lead to lower investment and potential job losses. As these effects compound, the risk of recession grows, highlighting the interconnected nature of consumer sentiment and broader economic stability. Manufacturing activity is closely monitored using the Purchasing Managers' Index, or PMI. This index provides valuable insight into the health of the sector by surveying managers about new orders, production levels, and employment. A PMI reading above 50 indicates expansion, while a reading below 50 signals contraction. When the index falls below this threshold, it serves as an early measurable warning that demand is declining. Such a shift can precede broader economic slowdowns, as reduced manufacturing often leads to lower business investment and employment. Tracking the PMI allows analysts and policymakers to respond proactively to emerging trends in the economy. Declining stock markets and falling corporate earnings often signal a shift in investor sentiment. When companies report lower profits, it suggests that their operations are facing challenges, which can dampen expectations for future growth. As a result, investors may become more cautious, leading to reduced demand for stocks and further market downturns. These trends reflect broader concerns about economic stability and the potential for slower expansion ahead. The interplay between market performance and corporate earnings serves as a barometer for confidence in the business environment. Ultimately, sustained declines can influence investment decisions and shape the outlook for both companies and the economy as a whole. In summary, it's important to recognize that no single economic indicator can predict a recession with complete accuracy. However, when multiple signals begin to point toward trouble, history has shown that a downturn often follows. These warning signs may be subtle, but together they can paint a clearer picture of the economy's direction. Staying informed and attentive to these developments can help individuals and businesses prepare for potential changes. By understanding the patterns and signals, we can better navigate the uncertainties that lie ahead.